Okay, everyone, welcome back to Premier Study and Investing. We're going to be looking at Quidel, ticker QDEL. You can see on the chart. I'm going to run through my normal progression. Quidel, if you're not familiar with it, is a diagnostic company. They made probably 85%, if just a rough estimation, about 700 million over about 810 million this quarter on the sickness type diagnostics. So if you've been with me for very long on this channel, I like to buy when these companies have a little bit of bad news come out. If I believe in the fundamentals, I will look at the ratios, but this is essentially their chart. We're down at $1.82, and I already bought because I had a $190 limit buy order set. So I got a notification about 9 o'clock this morning telling me that I had just purchased one extra share. So I'm not investing a lot in this company, but I do really like them. Let you look at this while I chat a little bit. I think the diagnostic space is a little bit safer. I'll try to give you at the end an article, maybe you already saw it, about some of the, I guess, continued need for testing that we will expect to see. And I'm going to disagree right off the bat with a couple of authors who said that, well, the justification in the price, spot price, or the share price falling today was based on expected lower numbers of testing in the future because of all the work that's been going on. I'm not sharing their opinion on that one. I'm going to go over to Investor Observer, and one thing I like about Investor Observer, they give us some, I don't know, 55 out of 100, but I've never really looked to see how they calculate that. The other thing I like about them is they give us just a quick look. They have an analyst that they've gotten 175. Well, right now we're trading at what, 182.91 was the last price on Friday. So this was Friday. Yesterday, after the close on Thursday, they had their earnings report come out, and then we had the big drop, $27 price drop today. So we'll look at some of the reasons why, but we have a couple other analysts saying it could be up 32% or up 64%. One of the things that I really like is I've talked about, now this PE isn't outstanding, 25 times, but it is a lot better than some of the other companies. Of course, we know that the average of the S&P is somewhere around 36 for PE, so this is lower than the average for the S&P. Also, we do have a company that is making money, profitable, earnings of $8.52 a share, so that's nice. It's not like they are pre-revenue or pre-earnings. They are profitable. One thing I like about this sector is that normally it is not very highly correlated with the larger market. There's been a lot of people talking about correction, crash, all kinds of stuff like that. So with a beta of negative 1.54, I didn't calculate this. Obviously, this is their number. So go and check all these because sometimes these have been wrong. But also the PEG ratio, this is price to earnings growth. I'll throw up a little graph or a little slide that I saw that I thought was helpful. But you'd like your PEG to be under 1, and this is pretty significantly under 1 at 0.25. So typically that means it's attractive, or at least it's a good indicator if you want to use the PEG ratio as an indicator. Okay, so this is the fourth quarter highlights, as you can see, and it's pretty hard not to like these numbers. Total revenue increased by 432% to 809.1 million. Analysts were expecting 809.1, so they beat it by $100,000, but I guess it technically counts as a beat. You can see some of the other numbers here. What's really interesting is they did receive an EUA for their Sophia 2, but the flu and like the antigen, like a combo. They kind of called it a combo in the third quarter call. So they also got the EUA for QuickView, which is an antigen test. So they already had an antigen test before. So now apparently they have another one. This looks like a point of care segment. If you want more detailed information, they do, of course, have their earnings call on their website. But I want to give you this just kind of quick and dirty. Received EUA for Solana, which is something they were talking about on Q3 earning call. And so they already got EUA. So the full year 2020 highlights were also, I think, pretty impressive for those of you who are new to the company. Total revenue increased by 211%. Revenue from the pandemic products was 1,164 million. They also received the EUA, it says, for 6 different diagnostic products ranging from PCR to isothermal molecular to rapid antigen technologies. So the big question really with this is I want to show you their ratios. So I've done this before, but I want to go and do this again, just a quick ratio comparison. Now, I don't know if these companies use the same, I imagine they're all US companies, BDX, Abbott, Qdel, Pharmaceutical, which does testing in Quidel. Let's assume that they all use GAAP. Let's assume that they all use the same inventory methods. PE 24, 49, 50, nothing. Price for forecasted earnings is lower. You'd like that to be lower. Price per cash flow is higher. Sales growth for Qdel is 94% 1 year, 23% on the 5 year. EPS growth over 1 year, year over year, 12 trailing months is 374%. Blows really these other companies out of the water. EPS growth, they don't have that. EPS growth forecasted 1 year, 540%. So depending upon how much you love these, and assuming that the company hasn't really manipulated or smoothed any of these numbers out, gross profit margin is very high, operating margin very high relative to their competitors, net profit margin, cash book value, 2020, it's trading at, what was it, about $200 a share, $182 a share. And you can see that these are not exactly the same size companies at all. So you wouldn't really want to compare these side by side in a true sense, but they are in the same categories, and they would be competitors for the same market. We'll add OPKO in as well, since that's another company that I cover in this space. Which OPKO had some good sales growth, good EPS growth, although not 378%. EPS growth expected is negative though. So again, it depends how much, and I want to do a video based on how do some of the analysts come up with these videos, because ratios, because I've seen that they're not always so straightforward as we might believe. But anyway, you can look at some of these other measures. Current ratio, quick ratio. One of the things about Quidel is they don't have any debt, so it's definitely not one of those zombie companies. And then the return on assets, 35%, return on equity, 53%, return on investment, 41%. It's just much higher than all these other companies. So this author gives us their analysis. They say Quidel's revenue and adjusted earnings were both slightly better than what Wall Street expected. So why is the company stock diving? Here's my best guess. With an increased amount of the population getting vaccinated, the need for test kits for the disease might decline. And while the healthcare company will continue to profit from its related efforts, its revenue growth rate will likely drop, given that Quidel's stock soared by 134% in the last 12 months, largely thanks to its revenue from pandemic testing. The prospect of decelerating top-line growth isn't appealing to investors, which may explain today's sell-off. So jumping over to Keith Spates, he does another article, and I love Keith's work. Basically, he says Quidel's strong year-over-year revenue growth was primarily driven by its revenues from Rona products. These products in the fourth quarter was 678, which was nearly 84% of the company's total. So really, like we said, all their eggs in one basket. The big jump was in the rapid immunoassay products, with fourth quarter revenue increasing by a whopping $566.3 million from the prior year to $631.3 million this year. So yeah, an increase. He says Quidel Sofia and its Sofia combo flu and sickness test fueled this growth. Revenue from the molecular diagnostic solutions soared by $89.4 million to reach $94.6 million. So that was a whole lot more for that in the fourth quarter. This remarkable increase stemmed from the company's Lyra, which is their PCR, which pulled in $87.2 million. Now, I don't know. The other thing to look up would be what is going on with the, say, South African variant and stuff like that, because if you've looked at, was it T2 Biosystems, ticker TTOO, the problem with their PCR test, reverse PCR test, is that they can only do 60 tests per day. So that's a real huge problem. That's why I kind of stayed away from that company, even though they've done okay. Outside, anyway, of the basically pandemic testing, the picture wasn't impressive. The cardiometabolic immunoassay revenue rose 6% year over year. Specialized diagnostic solutions fell 20%. So why did Quidel's share have fallen after our trading, after the company turned in very strong fourth quarter performance? It could be in part because the revenue was essentially in line with analyst estimates. And he says, but investors are almost certainly concerned that the testing revenue might decline rapidly as more people get vaccinated. Note from the CEO, Douglas Bryant, pointed to 2 new product launches on the way. In his comments on the quarterly update, he noted that the company plans soon to launch its Savannah multiplex molecular analyzer and the Sophia Q analyzer, a really smart product that could serve new markets such as telemedicine. Okay, but the main thing to watch with Qdel is what happens with its testing demand. So I remember from Q3, Douglas Bryant, the CEO, said that they were not even going to catch up with demand, that they were basically had back orders and stuff. They were not going to be able to ramp up production and manufacturing in line with all the people that want to buy their products. So I thought that was very strong. I remember revenues were up 270. I can't remember the thumbnail. It was like 276% last quarter, Q3. So let me just end it off here with this article that I did see coming out of NBC. So I think this is going to say a lot, at least in my personal opinion. A news article coming out of NBC from San Diego. It says San Diego County reports its first case of fully vaccinated person getting positive test results. So it says we do expect more cases of vaccinated people, getting the virus. San Diego County's epidemiologist said, we expect the number to be low. We expect most of the cases to be like the one that was just reported. So, if this is true. I can't see any of these administrations or municipalities letting off the gas when it comes to testing, especially businesses, anything that has to do with public, public impression, public sense of safety. They're basically going to, I mean, if you're asking me now, don't take my advice. This isn't investing advice, but you can see this kind of everything would pivot on this. And even if the whole vaccines roll out as smoothly as possible, I would say that I don't know that I could agree with these two article writers from the Motley Fool that the price is down due to testing. I think people are still going to test quite frequently. The nice thing about testing companies is that you don't have to pick the one that has the special formula like we saw before. These guys are already making money, these men and women, I should say, already profitable. They have a low price for the growth that you're going to get. The beta is low. So anyways, well, that's my take. Good luck to everyone out there. Enjoy the investor presentation Q4 earnings call if you need more info. Okay, thanks.